But let's now shift focus and let's talk about what's happening within the hotel industry and this entire reopened trade which is once again playing out. Let's, of course, with Indian Hotels also take stock of the recent fundraising that they did, what's happening with the Qmin app, and of course, demand for now bookings as well as their ARRs as well, perhaps, would be set to rise. Puneet Chhatwal, the MD and CEO at Indian Hotels Company on the show, joins in right now here. Puneet, you've already started deleveraging your balance sheet, reducing your net debt to about 170 crore rupees at the end of December, as I understand. You also have plans to deleverage the balance sheet completely. Are you on track with this fundraise, and what was the fundraising rationale?
Thank you for having me. The opportunity that is presented now is very interesting for us going forward. Having had a very difficult 2 years period for the hotel industry in general, including airline and tourism, we thought this crisis did teach us something about having as little debt as possible. So the new capital structure will either be without debt or as little as possible. Second, very important is to scale up our new age businesses. That includes our home delivery and our QSR brand, Qmin, together with Ama, our homestay brand. And finally, also the reimagined Ginger. We call it also a new age business, as it could be leveraging digital more. And last not least, to make the company have strong fundamentals, a strong platform going forward. So if there was another black swan event like the pandemic, we are better positioned to tackle that, and more focus would be on operating margins, on free cash flows, and having this healthy balance sheet structure.
Right. Puneet, thankfully, the Omicron impact was rather short-lived, which clearly sets your expansion plans back in full swing. What's the update, as you plan to sign around 17 new hotels, I understand?
So our new age businesses give us margins north of 50%, which is unheard of in the typical traditional hospitality business. Having said that, they do form a very low percentage of our revenue today. So our focus will be in how to scale up these businesses. That's number one. Number two, our growth was what we had committed to a hotel a month. With the opening of the Ginger in Kochi today, we have done more than a hotel a month in this current financial year. And we think going forward, on the basis of the pipeline numbers we have today, if there was no fourth or a fifth wave or no further lockdowns, we expect to open anywhere between 16 to 20 hotels, another maybe 50 to 75 homestays, a few more QSRs. So our growth journey is definitely very, very strong, and it's based on a fee-based model, so no capital upfront expenditure from us. I think we are very, very happy to share that, and we have given this kind of guidance before. And despite the pandemic, we've been able to walk the talk. So I see no reason that why we should not be able to increase that number from one hotel a month to at least 1.5 hotels a month.
Mr. Chhatwal, hi, good morning. What about, the concern for the travel industry as a whole? A slower than expected recovery in international demand, even a potential decline in corporate demand, that could clearly seriously impact your key hotels in Delhi, Mumbai and Bangalore. Are you worried?
Corporate and the business demand was lagging behind in all the three key cities of India. That's your national capital, Delhi, the commercial capital, Mumbai, and the tech capital of Bangalore. Having said that, what we have witnessed in this month of March and going forward in April and May is that our business on the books and the pickup on a daily basis is trending higher than March, April, or May of 2019. And I make this statement based on the same store. If we add to that the growth of new properties, the growth in the brandscape, as well as the portfolio, we feel that at the moment, everything is fine. Having said that, we are living in such a volatile world. We have hardly gotten over the Omicron bad news for the industry. Then came another bad news on Russia, Ukraine. And now the good news is, as of a few days, we have opened the air traffic. It'll take a couple of weeks or maybe 4 weeks to settle down. And also the demand is becoming very strong in cities like London, New York, which are very important for us. I was a few days ago in Dubai, where we had the grand opening of our third Taj property, the Taj Exotica. And I have to say, it's off to a flying start for the very first month of business. So demand in international is picking up. And some are the winners of the pandemic, cities like Dubai or destinations like Maldives. Others that are suffered are hopefully going to pick up very soon.
Okay, so good to know that expansion plans are on in full throttle. And now on the cost side, some of your costs seem to be back in the business with the increased size of operations. You plan to have sustainable cost cuts, I understand, in the range of about 15% of pre-COVID levels. So how is that going to help to improve your profit margins going forward?
Very simple maths. I mean, pre-COVID, we were at around a portfolio of 150 hotels. Today, we are at 230. We have a decrease of anything like 15 to 25% sustainable decrease in just corporate overhead, similar decrease in costs, both fixed and variable at property level. I think the industry has done very well to use these 2 years to relook and examine all the expenses that we had. So I think going forward, our cost per available room or cost per hotel in the portfolio will be significantly lower than the pre-COVID level. And that number could be higher than the 15% that you have mentioned.
Right. Mr. Chhatwal, good morning. This is Nentara also joining in this discussion. Now, if you look at the EBITDA margin that you're guiding for, it's in the range of 30%. Mr. Chhatwal, that's much higher than the 18% average margin that we've seen in the last 7 years. How are you checking in with this kind of optimism? What's the rationale?
Well, there is nothing comes from nothing. I think we announced in February of 2018, Aspiration 2022, when we stood at 17% margin to take it to 25. Just when COVID hit in that year, 1920, which was almost 50% of our journey, we had hit 25% margin, obviously aided by, marginally aided by a change in the accounting and reporting standards. However, even if we discounted for that, we would have been at 24%. So we had the 700 basis point net increase, and with the change in accounting standards, almost 800 basis points. And given that we are focusing so much on scaling up new businesses, scaling up our reimagined Ginger brand, these are high margin businesses. Also, our asset light growth, we have added 80 contracts to our pipeline, and more than 70-80% of those are on a fee-based business. So when you take a combination of all this, then the margin expansion has to come unless a pandemic continues or there is some other world event that comes and comes in way of your strategy. But mathematically, of course, we're on a good way. And I think our Q3 results, when we posted with 80% of the revenue of pre-COVID, we did almost a 30% margin. So I think that would be interesting to watch. What happens when we cross 100% of the revenue of pre-COVID? And we had the new growth of new businesses, where that margin would be.
Okay, so that's how hopefully we will see the company report the 30% margin, the rationale behind that optimism. Now, Mr. Chhatwal, we would see the third quarter fine print. There was almost a 95% recovery when it came to the average room rate. We saw 94% recovery in occupancy from the pre-COVID levels. If you look at the average revenue per room, RevPAR, as the common parlance in hospitality, the key markets are doing better than the rest of the industry. How sustainable is it, and how are you going to maintain that, if not grow it?
We will remain as focused as we have been in the past to keep driving our market share across geographies, to make sure that our portfolio mix and our brandscape grows in a healthy fashion, making sure that we don't invest into assets which create short-term challenges for us or have a high upfront expense. If we followed all these three things, plus having a very strategic roadmap as we had come up with Aspiration 2022 and followed by what we call the Reset 2020 because of the pandemic, I think very soon we'll have a capital markets day in which we'll provide that guidance, and the guidance will be very much in line with what we had as our aspiration in the past.
Right. Also, Mr. Chhatwal, your Qmin GMV of 58 crore rupees during the last 9 months, as well as the Ama Stays GMV was about 11 and odd crore rupees. Wanted to understand what kind of growth do you now foresee and pencil in from these two business models?
On the contrary, actually, as business comes back in our traditional, set of P&L, I think the pie might, from a revenue point of view, might decrease, but the contribution margin on the EBITDA level and on the PBT level will continue to increase. So I think these are good businesses, and it would be unfair to compare a Qmin and an Ama, which is not even 2 years in business, versus, let's say, our backbone, the Taj, which is more than 118 years in business. To get to that level, of course, it will be a slow and steady progress. Slow because we are not putting too much upfront capital in it, and steady because we have proven that being present in 20 cities, going on to 25 or 30 cities with Qmin, having a portfolio of almost 80 Amas. We had already guided about 74, then it went on to 76. As we speak today, we have signed another 4 with more than 45 in operation, very soon to hit our first 50. I think we are on a good track, and these businesses will continue to grow in a very steady fashion.
Sure. I know we've often wondered and talked about it as well, but is there a possibility that you could list the ginger business separately perhaps at some point after you develop this business, maybe even several years down the line?
It's too early and premature to make any of those comments. What we have definitely done is, and we have communicated that to the market, is we have acquired almost 100% of the shareholding in the Roots Corporation where the Ginger brand sits. We always had a little north of 60% before, and a few percentage is left till it becomes a wholly owned subsidiary of IHCL. I personally feel this is a very exciting brand to watch. Ginger can be in every district capital of India. And if I add to that the metros, the future is very, very big. And this could be possibly in terms of number of hotels, not in number of rooms. It could be a very, very big brand. And that can happen within the next 5 to 7 years.
You've also renewed the 4,000 crore investment platform formed with GIC in mid-2019, and now looking at potential hotel assets that are distressed or that are underperforming. So how has that shaped up so far, and what kind of assets have been identified?
Well, having a platform with GIC is actually a blessing that we have a platform. And we are very excited going forward. The last 2 years was a complete wipeout. Having a platform or not having a platform did not help much because the gap in a buyer's expectation versus what a seller was willing to do was so massive that none of the deals could have happened. Otherwise, we would have heard about several deals happening on our platform or other platforms or with other companies. So I think as the gap has narrowed, the activity will start becoming more fruitful going forward. And we are glad that we have this platform, and we are ready for and well positioned for any opportunities that might come our way.
And how do you plan to leverage the Air India buy even further? Because analysts say there can be some sort of a contract that all the crew that's employed with the Tata aviation business can stay at IHCL hotels or indirectly from the frequent flyer base of Air India. So what are the plans on that front?
Well, with or without Air India, Vistara or Air Asia, of course it is a help because they all form a part of like a tourism group. And if we all work together well for a better future for the industry in general and for our group companies in particular, it's a positive thing. It would be a little bit unfair to think that we were not already in business with Air India. I think more than 50% of their meals done through our company called TajSats in certain destinations were already being done by us. I think the bigger opportunity is synergizing with all group companies, and we are a very large group. We have a lot of opportunities, and you know, I think it's just the beginning. And of course, airlines, airline crews, airline catering, airline lounges, these could be all businesses that could be of interest to Indian hotels. And if they make financial sense for us and makes financial sense for our sister companies, we would definitely do anything that it takes to synergize to take them to the next level.
Okay. Now, Mr. Chhatwal, and we've seen those images. Some of us have traveled as well, and the airports are really, really crowded. I mean, just going, when you look at the airport, it seems like back to pre-COVID levels. What are the travel trends that you have seen? What kind of hotels are seeing the best occupancies?
Well, travel is beginning to come back, as I alluded uh, to a situation that March, April, and May are trending higher on the same store basis versus March, April, or May of 2019. That is coming through the travel. And both the traditional business, corporate, conference business, as well as the leisure business are getting stronger day by day. Leisure was very strong for the last 8-9 months, and it's holding that position. But the corporate is beginning to come back. And my own personal experience has been in the last few travels that I have done, the airports are full and there are long queues. So that is very encouraging. Pre-COVID, sometimes we used to get upset why there are so many people. And now coming from this industry, I tell you, I feel very happy to see full airports and long queues, even though that may not last, this happiness may not last forever. But at the moment, yes, it's a nice feeling to be in an industry that was so badly suffering, to see the number of people coming back again.
Okay, so corporate travel is also starting to stage a comeback. We're running out of time, Mr. Chhatwal, so this will be our final question. Shareholders that invested in Indian hotels have certainly reaped in the rewards. Today, after the QIP has been closed, you've given us an outlook on the business. What would your message be to the shareholders going forward?
I think long-term messaging for our shareholders, not just shareholders in particular, I would say for all stakeholders, is staying true to our core values of both the group, the Tata Group, as well as the Taj Group, as we are popularly known as. And where Taj stands for trust, awareness, and joy, that's the purpose that we have defined, to have trust of all our stakeholders, to have awareness of what is happening around us in the communities, to make a difference in whatever we can and contribute in a positive way, and having the joy of doing that, a real joy, a joy coming from the heart.
Right, Puneet, such a pleasure having you on the show today, and thank you for, as always, speaking so candidly with us.